Many people in finance have been trying to predict where the next major crises will begin. We remember that in 2008, during the Great Recession, we saw the consequences of the collapse in bank lending tied to residential real estate, which triggered a domino effect that not only shook the US economy but also had global ramifications. Since then, numerous experts have attempted to identify the next potential economic bubble, but so far, no one has been correct. Not since 2008 have we experienced anything close to this. However, there are now new signs of an emerging crisis that everyone seems to be brushing off. This looming threat could potentially have a more devastating impact than the 2008 crisis, possibly even rivaling some of the worst economic storms America has had to endure, and its origin story is actually pretty easy to recognize. If you've been keeping up with financial news, you may have come across the story regarding the issues faced by New York community banks, specifically concerning non-performing loans. At first glance, it might seem like a story about an obscure regional bank that isn't widely followed, discussing a relatively specialized and niche topic. You may wonder why bother with this seemingly insignificant matter. However, if we dig a bit deeper, we begin to realize that the New York community bank story could potentially mirror the broader narrative of the American economy, a narrative that points to a ticking time bomb. To grasp the significance, let's take a step back and start from the beginning. You see, back in early 2020, before March of course, in the vibrant city of San Francisco, Union Bank decided to sell its office headquarters. The building, located at 350 California Street, sits right in the heart of the city's bustling downtown area. It was put on the market with a price tag of $250 million, which at the time was seen as a reasonable and justified amount. Fast forward 4 years, and this very building is being purchased for around $65 million. This represents a staggering 74% drop in price in just about 4 years, highlighting a dramatic shift in the market. But this jaw-dropping price movement isn't an isolated incident limited to San Francisco. It's a trend that's unfolding nationwide in what's now being referred to as the commercial real estate depression. Triggered by the shift towards remote work that took off post-2020 and compounded by increasing crime rates in many of America's largest cities, this plunge in commercial property values is a phenomenon that stretches from the West Coast all the way to New York City. The impact of these changes is profound, reshaping the landscape of urban centers across the country. As more businesses adapt to remote or hybrid models, the demand for office space has plummeted, leaving landlords and investors grappling with the new reality. This commercial real estate depression is a clear sign of the times, reflecting broader economic and social shifts that are redefining how and where we work. These sudden shifts have understandably caused significant disruptions within the banking sector, disruptions that are only now beginning to surface in news reports. Given these developments, there's a growing consensus that these issues may represent a much larger problem than previously anticipated. If you don't believe me, let's just take a look at one specific situation that unfolded very recently. As I mentioned, New York Community Bank is a regional powerhouse with about $111 billion in assets, making it the 35th largest bank in the US. Sure, it isn't a massive name like Chase or Bank of America, but it's still a popular name, listed higher than a lot of the banks you know and bank with, such as Deutsche, First Horizon, and Comerica. On January 30th, 2024, following a startling earnings report, NYCB's stock plunged from $10.38 to $6.47 per share, marking a staggering 37% decline in a single day. In the brief period since its earnings announcement, the bank's share price has further nosedived to $3.74 as of this writing. This equates to a 64% decrease from its previously stable level just 1 week ago, positioning its recent downturn as more severe than the declines witnessed during the 2008 financial crises. The pressing question now is, what exactly was disclosed in that earnings report to trigger such a drastic reaction from investors? And this is where the real surprise is. It turns out that on the surface, it seems that the company finally realized that some of their commercial loans are bad, and these loans will essentially be written off as serious losses called a charge-off. But dig a little bit deeper and you find an even more shocking truth. We all know regional banks are major players in the commercial real estate game, and plenty of them are loaded up with an abundance of bad debt. So why such a serious reaction right now? Well, I believe it has something to do with simple logic. You see, in this specific situation, if you dig into the earnings report, you find that really it was just two loans that essentially caused this entire ordeal. You can read the report for yourself. The section I'm talking about is right here, and what it basically says is that yes, the loan losses were primarily related to just two loans, the first of which is right here. If we read it, it sounds like jumbled financial garbage, saying, quote, "First, we had one co-op loan with a unique feature that pre-funded capital expenditures. Although the borrower was not in default, the loan was transferred to held for sale during the fourth quarter." Purely speculation here, but the use of vague language like pre-funded capital expenditures might suggest that the bank is attempting to mask a risky lending practice or a brash decision. It's possible that the borrower received a large sum of money up front for capital expenses without adequate scrutiny or proper assessment of the project's viability. This could indicate a lack of diligence on the part of the bank in ensuring that the funds were being used responsibly and effectively. On top of that, the term unique feature could imply that this arrangement deviates from standard lending practices, raising questions about why such a departure was allowed and what potential risks it concealed. Overall, the statement may hint at a situation where the bank's leniency or oversight led to a problematic loan structure that ultimately resulted in serious losses. Then the statement on the second loan is no better. It states, "Second, we had an additional charge-off on an office loan that went non-accrual during the third quarter based on an updated valuation. Given the impact of recent credit deterioration within the office portfolio, we determined it be prudent to increase the ACL coverage ratio." Now, cutting through the financial and lawyer jargon, you have to ask yourself what this also really means. The last statement seems to imply that there has been a broader trend of worsening credit quality within the bank's office loan portfolio. So as a precautionary measure, the bank decided to bolster its allowance for credit losses to provide a greater buffer against potential future losses. This, at least in my opinion, seems to suggest that the bank anticipates further challenges or defaults within its office loan portfolio and is taking steps to mitigate the associated risks. And all of this trouble is just from two loans. This should make you think, if just two loans can lead to such a dramatic drop in the stock price, what else might be hidden in the financial details? Not just in this bank, but in other regional banks too. If so few loans can cause such a panic, imagine the reaction if more issues come to light. These dangers could potentially put a massive strain on the entire banking system, and we all know what happened last time when such an event occurred. By the way, it's not just me warning of this danger lurking in the shadows of massive office buildings, apartment buildings, and retail centers. This guy, Warren Buffett, has recently warned of the dangers as well. Just take a look at this interview where Warren specifically calls out commercial real estate as a source for potential danger.
We have had lots of investors in commercial real estate who have come in and said that this is going to be a crisis point, that the government is going to have to step in. That something should be done because there are so many commercial real estate loans that are coming due between now and 2025, and that they won't be able to get credit from the banks in the same way to renew or to, once those maturities come due, to refinance.
Well, let's say they lose $100 billion in the banking system. Most of the banks can take that loss, their share of that loss, and a few of them, because they did other things, their shareholders will end up losing the money, but the depositors won't lose money. But if you lend money to somebody and it comes due and they can't pay, the old story about the banker, I never made a bad loan. Of course, some of them turned bad after I made them. I mean, and that's exactly what happens in, whether it's in commercial real estate. And if money rates are 2%, or we were lending money out at 4 basis points at Berkshire to the federal government, not much more than a year and a half ago, or something like that. And if those rates change, let the person who bet that they wouldn't change lose money. I mean, that's if you make mistakes in business, plenty of people make mistakes. You pay for them. If you've got a big profitable business on top of it, which a good many banks do, you take your losses and you keep going on. I mean, banks can take a lot of loan losses, but they can't take something that wipes out their capital and expect the world to ignore that fact.
Meaning that you don't think anything needs to be done on the commercial real estate front?
Well, I think that the people The people who lend too much money should take losses, and they're getting properties handed back to them now. I mean, within the last month or 6 weeks.
Banks are.
Yeah, I mean, they got some office buildings in Los Angeles, and Blackstone walked away from something. I mean, and if you get a non-recourse, everybody goes in the real estate business is told the first rule, the second rule, the third rule is never sign your name to anything. And so you have non-recourse mortgages, and they're going to walk away, and the bank's going to get stuck with losses, and maybe they'll hold the property a long time, and it'll come back. And there's all kinds of ways that if you got capital strength, you may decide, well, I'll just hold it. But that money is sterile for quite a while, and that's part of banking. I mean, you expect to lose some money in banking.
Now that we've heard from the expert, the question arises, where is the evidence? It's been 3 years, and one might wonder if there were a problem in the commercial real estate sector, wouldn't we have felt the impacts by now? The straightforward answer is perhaps not. This is because the commercial real estate sector is among the most bizarre and confusing sectors in finance. It's a complete enigma. While residential real estate benefits from numerous reliable indexes, methodologies, and dedicated companies tracking market trends, commercial real estate faces limitations in this regard. Unlike its residential counterpart, commercial real estate transactions are relatively fewer in number, and the sector is fragmented into distinct categories that often exhibit significant variations. For instance, warehouse properties in California may thrive, while apartment complexes in Austin might struggle. Each commercial real estate category presents its own unique dynamics and challenges. However, there are clear indicators emerging from various sources signaling serious trouble ahead. For example, if you examine the limited indexes available, a clear downtrend is evident. Although the figures may not appear alarming at first glance, the trend is unmistakable. The Green Street Commercial Index, which peaked in May of 2022 at 153.1, has since plummeted to 121.8. This marks a 21% decline from its peak. This trend aligns with other prominent indexes such as the MSCI index, which has shown a similar downward trajectory since the summer of 2022. Furthermore, the CoStar Repeat Sales Index also confirms this trend, demonstrating a significant drop in its value-weighted readings across various metrics. Interestingly, due to the unique characteristics of the commercial real estate industry, the actual impact may be far worse than these initial assessments suggest. Take commercial REITs, for example. These entities operate similarly to mutual funds but are focused on real estate. They aggregate funds from numerous investors to purchase and manage a variety of commercial properties, including office buildings, shopping centers, hotels, and warehouses. This sector's performance can often provide insight into broader market conditions. For instance, Alexandria Real Estate Equities, which specializes in office buildings, has seen its stock price decline by over 47% from its most recent stable peak. In similar fashion, Kilroy Realty Corp., another REIT focusing on office spaces, experienced a significant downturn as well, with its stock price falling from $78 in April of 2022 to $34 today, representing a 55% decrease. These examples underscore the potentially severe consequences that can manifest within the commercial real estate sector, often indicating deeper issues than surface-level data might suggest. According to Moody's Analytics, a particularly alarming finding from a recent report is that in September 2023, a portfolio of properties failed to meet their loan repayments on time, leading to a 10% payoff rate for that month. This, in simple terms, means that there was a staggering 90% default rate during this period. The September data point marks a significant and worrisome milestone, suggesting a potential collapse in the commercial office market. Furthermore, when examining the year-to-date data for 2023 up to that point, the report shows that the office sector had achieved only a 30% payoff rate, meaning that more than 70% of commercial real estate loans were not successfully repaid. These findings highlight the critical challenges facing the office commercial real estate sector, casting doubt on its stability and future viability in 2024. Given the particular nature of commercial real estate leases, which typically range from 3 to 5 years and can be extended up to 10 years, the full extent of price damage may not be apparent yet. The current observations, though concerning, may only be scratching the surface. It's important to understand that the real impact often becomes visible only as these loans approach maturity. Therefore, the possibility of more significant challenges ahead should not be underestimated. We might currently be in the early phases of uncovering the broader implications for the commercial real estate market, suggesting that more difficulties lie ahead as more loans reach their due dates. Given the heightened sensitivity of every bank, even a few properties failing to pay can trigger a chain reaction capable of destabilizing the entire system. As significant price collapses are only beginning to materialize, it becomes increasingly apparent that the system is under severe strain. Could commercial real estate serve as the catalyst for a broader economic downturn? Share your thoughts in the comments below, and if you found this video insightful, be sure to hit that like and subscribe button.